This video will be daily bias part 2. Now, you're probably wondering, what could I say about daily bias? Because remember what I said last time. What I said last time in the daily bias video is you will not typically use the daily candles for a bias. You might sometimes, but typically that's not the case. For what we do, we kind of scalp or day trade. You typically want to use the 1 or 4 hour. So I wanted to make a part 2 to daily bias because I want to show you a little more, now that you understand IFGs more from my IFG video, about how I actually use bias using inverse fair value gap. So honestly, the biggest thing for me and using the 1 hour and 4 hour is I look for SMTs and I look for inversion fair value gap. So let's say I see a very obvious fair value gap, and this one points out to me right away. It's very clear, it's very visible, and it looks like the average retail trader would long it. And you can see that is true. People longed to here. It worked. It was nice. So how do I use this in my bias? Well, I kind of create conditions. So I use the 1 hour, 4 hour, whichever one looks better. I mean, you could probably use both the 4 hour, 1 hour here, to be honest, but I think the 1 hour is fine. And I kind of think using common sense. So my common sense is we have a big gap here. As long as we hold it or above it or get some sort of lower time frame reaction off of it, which this would be like obviously this is a 1 hour chart, but if you see like a 1 to 5 minute bullish reaction off of it, then I think that would be bullish. I would take the long setup. But the moment we kind of stall, don't get that long setup, and then dump through it, I will completely switch my bias to being bearish. So as of now, because we dumped below this hourly, I am bearish. Now, something that's interesting is we already kind of got half of the bias played out, because you can see this candle close below this gap here. So I kind of predicted this dump already. Now, could we go further? Of course we can. We could go to this low next. But now I'm going to kind of probably play what price action tells me, because tomorrow we have FOMC. So tomorrow's not going to be an easy bias day for sure, because FOMC usually takes up both sides. But yeah, I mean, I use SMTs and I use inversion for value gap. So you kind of saw my SMT video, and you saw my other fair value gap, or you saw my SMT video. So IFGs and SMTs. Now, if we go to the hourly here, you can actually see there's actually not an SMT up here. Actually, I think there might be. Let's see. Okay, there actually is. It's very small, but I'll show you where it is. So if we go to the 15-minute here, sorry, there is an SMT here. So you can see that this high got taken on ES, but you can see in NQ it was actually never taken out. So how does it help us? Well, it doesn't help me in live time that much. I'm not going to lie. It doesn't really help me this much. Now, the funny thing is, this is actually at 6 p.m. Eastern. I'm not trading then, okay? Or, sorry, this is at 6 a.m. I'm not trading at 6 a.m. And then this happened to be 8:30 news, okay? Which is also interesting. So, when I see price come up, fail to take this high again, and then go back down, I would say by this candle right here, I'm not even going to try to lie to you guys and say in hindsight it would be this candle. I would say by this candle, I'm almost confident the bias is likely bearish, because we have an SMT. Now, this is one of the situations I did get tricked. I kind of was looking for a long setup here, but we weren't really getting much in the lower time frame. So I actually ended up switching my bias here a little later than I should have. But there's an SMT here. You can clearly see that NQ took out the high, and ES, or NQ did not take out the high, and ES did. So that, along with the bearish momentum here, kind of tells us we're kind of going to go lower. Now, what if you didn't figure it out on this candle? What if you missed the SMT? Well, knowing we have the SMT, maybe you see it like a day later. Maybe you see it an hour later. And an hour later, you see us dump through this hourly gap. Well, you still probably know we're probably going to keep likely going down, because it's common sense that we bounce off a fair value gap like this, which also makes it common sense when we violate it, such an obvious gap, we're probably going to go down. Now, you're probably wondering, would I use a gap like this? Like if we violated this or went through this, would I think we're bearish? Yes and no. This one's definitely a lot lower. I can't as much guarantee us to go down off this one than I can for this one. This one's much more obvious. It's kind of way up here in premium, so it just looks a lot better to use. And I mean, sometimes these gaps way down a discount using for inverses, the short are just hit or miss. So you just got to be careful of these. I really look for obvious ones. I mean, this right here definitely helped me a lot. See this one right here? Now, this one we just completely blasted through it. So again, you got to realize if price action was truly bearish, we would have rejected it. And we just did not even try to reject. Same thing with this bearish gap here. I use both these gaps both these days for the bias. As soon as I saw this giant green candle, which keep in mind, I pay attention to the momentum a lot, like the kind of size of a candle, how fast the candle's formed, how many candles it takes to inverse something. I know, like looking at something like this, we're probably just going to keep going up. And again, it's just another example of how I'm using an hourly or 4 hour fair value gap to determine the bias. Now, you're probably wondering why I couldn't use like these two gaps as bias getting broken. You could have been, oh, this is bearish. But you have to realize it's not smart to short this low. And that's why I say these gaps weighing discount are like hit or miss. Because when we inverse them, yeah, we might go a little lower, but the risk to reward and us being in discount really isn't that great. That's why this is actually better to use for the upside. Same thing goes along for this one here. I mean, this is just so high to use as an inverse fair value gap. I mean, at that point, we actually did hit discount. So I won't not lie, this is definitely one of the fails that would throw you off. But um, if I do go to the 15-minute time frame, to me, 15-minute didn't look that bullish. I mean, these 15-minute gaps got broken right away, and we kind of formed another 15-minute broken fair value gap here, which I'm actually not going to do a video on BPRs because I feel like you don't need that if you know what IFGs are. But this is a BPR, so it's just called a balanced price range, and it's kind of when this bullish and unfilled bearish gap line up together, and it's one of the strongest points of resistance and support in the market. I just label them as IFGs to make it easier on you guys, but honestly, this doesn't look that too bullish, so this is one of the instances where this might confuse some people and might steer some people wrong, which is fine. There's going to be a couple of those. Same thing with same thing with this. So we have this one's in premium, and you want to short in premium. So we see a gap in premium. It's violated in premium, and what kind of candle violates it? Well, a death candle. This is what I call a death candle. This red candle right here. It's very bearish. It's very quick. We don't even try to bounce, and it cuts through a major fair value gap. A lot of retail traders are gonna be like, "Oh, we're gonna have a long off this." That's what a death candle is. So as soon as I see this red candle, it's just major. I'm like, okay, well, we now inverse this gap. A lot of retail traders are probably gonna think we're gonna bounce off it. So now I know we're gonna go much lower. So that's where I start targeting like this low, which is inside of a fair value gap, which people buy this wick on the buy side of the curve, which is why it's a good target on the sell side of the curve. ICT gem, sorry. And yeah, like, and then you just target this low, which it actually took a little bit for this low to hit, but it's not going to be the easiest trade in the world because we bounce and then go back down. It's tough to catch the whole move. I always tell people you don't need the whole move. You just need a piece of the pie. Sometimes you'll not catch the whole move. Sometimes you'll scale half and then your other half will get stopped to break even. It just depends. So again, you can just see I use inversion gaps for bias. Now, when you use an inversion gap as a bias, like when I use this, my main target is this high. I don't really target any higher. My main target's this high because this is the next high after the inversion fair value gap was formed. And I know it's going to hit most of the time. If I want to really know we're going to go higher, I want to see a very bullish reaction over this high. And we didn't really get anything that would have convinced me here. Okay, just a bunch of wicks over it. And again, unless we get a gap or major displacement over the high, I don't trust the inverse fair value gap to take me higher. The only exception is if we have like perfect equal highs here. Let's say we had perfect equal highs here, which we obviously don't. Then yeah, I probably expect us to go way up here at this point. But that's only certain situations. Another one here, just this is a bullish candle which wrecks all these bearish gaps. Again, I would say these two are the most obvious. There is one up here which it does wreck as well, but same thing with this. But you can see, I mean, it's just a bullish candle. It's wrecking a bunch of these bearish gaps where a lot of people are probably going to short. So my bias is bullish because that's why. Same thing with here. We get a very nice, obvious bullish gap here. I'm going to kind of combine it with a new week opening gap. So this is something called a new week opening gap right here. This zone right here. You usually get it at 6 p.m. opens on Sundays, Sunday evenings. And then there's new day opening gaps, which you get on Monday, Tuesday, Thursday, Wednesday. Which can also be used as support and resistance as well. So I kind of just combine it with the inverse in this situation. But anyways, what do you notice? Well, this is very obvious. It's very obvious. This is bullish. So we kind of respect it. But then the first time the body closes under it, that kind of tells me, okay, bias is likely going to be bearish because we just inverse this gap. So that's kind of what I'm thinking. Same thing with here. We have 3 gaps here. Market just completely wrecks through all of them. If the market was bearish, we'd probably reject these, and we didn't. The market just completely shoots through them. So what does that mean for the bias? It's probably going to be bullish, all right? And you're going to see there's all these examples of these inverse rally gaps. And yeah, even though they might not take us way, way higher, they still generally take us to the next few highs, which is good enough, okay? And good enough, it's good enough for a trade that's going to make you profitable, all right? So that's that. So this one is kind of respected, so not really bullish yet. This is where the volume starts to drop off on the old contract. But like this one, just there's this one to the left. It's respected at first, but completely gets blasted through. And again, if the bias is bearish, this will not happen. So what can you conclude when we blast through a bearish rally gap? Well, then we're probably going to be bullish. And again, it's just how I determine my bias. Maybe there's an SMT here as well. Okay, I like to add SMTs in my trading. So look for an SMT. You don't need, so you're probably like, oh, you need an SMT every time because Dodgy said so. You don't need an SMT all the time. I don't, like, yes, they're a good confluence, but you don't need an SMT. They're good, but you don't need it. You can experiment whether you want one or not. It's going to come with screen time for sure. Sometimes I won't not pay attention to them. Sometimes I will. It just really depends on the day. So that is it for now. Hope you guys kind of understand how I figure out my daily buys today. I use the 4-hour and 1-hour chart. I look for inverses. And you can also use the 15-minute chart if there's nothing in the 4-hour, 1 hour. So, I mean, that's just that. Like today, the only way it would have really went bullish today is if the 15-minute kind of closed back above this bearish gap. But did it ever happen? No. So I couldn't go bullish for that day. Okay, you can see we got a bullish one up here, and we did close above it, but you kind of see we already hit the high, that next high that's like almost a guaranteed take profit. It just doesn't, we don't really get a bullish reaction off this high, which tells me when this fails again, we're probably going to go down. So it's common sense, some of it, and you're going to learn this through screen time. I think it's very important because this video is definitely going to boost up your learning curve. And yeah, I literally just use inverses for bias on the 1 hour and 4 hour, and sometimes the 15 minutes. So that's it for now. I'll see you guys later. Peace.